GameStop is back, baby, for what feels like the 10th time. Once a meme stock, always a meme stock, and I don't know if it'll ever be dead. So what's the latest on GME? GameStop stock surged over 70% on Monday and then another 60% on Tuesday, following the return of Roaring Kitty, real name Keith Gill, who was at the forefront of the original GameStop short squeeze in 2021. Roaring Kitty posted this meme and then made a series of cryptic posts that had people speculating on what's the next big move. It could have been about GME, but also another meme stock, or something completely unrelated. But naturally, a lot of people started to think short squeeze. And short sellers were definitely hurt by the steep rally. Some reports estimated their losses to be around $1 billion on Monday alone, and over $2 billion across both Monday and Tuesday. But with that said, I don't think the same thesis behind 2021 applied here. Not only is GME stock not fundamentally undervalued, but the estimated short interest is less than 25% of the shares circulating in the market. And although that is a meaningful percentage, that's nothing compared to the short selling magnitude a few years ago. I think the rally was good old-fashioned buying action, fueled by both retail and institutional trading. General speculation leading to people jumping in before they miss out on the wave, the usual FOMO, the momentum trading of institutions, and their algorithms. Wednesday might have showcased that. GME fell by about 20%, and the declines continued into after hours. Only 2 days went by before correction. I'm sure someone that bought in at 64 is at least wondering if they got the rug pulled. Now, I'm filming this Wednesday evening, so I have no idea what happens tomorrow or Friday. GME could go up, or it could go down. But my message is the same. Be careful. The problem with buying GameStop is the stock price has a tendency to deviate from the company's fundamentals, meaning the stock could be incredibly valuable while the underlying company is not. So if GME rallies again, the company does not have the fundamental foundation to justify that those prices stay high over a longer period of time. Eventually, the price will correct. But when that happens is so hard to determine, and that's how you get screwed. There's a ton of risk involved with chasing volatile positions in hopes of cashing in big and cashing in fast. So if you're going to do it, don't lose your shirt. Only bet the amount of money you're comfortable with seeing go to zero. And that's my approach. The latest on Tesla that I want to touch on is really about their competitors overseas. And so y'all know, I'll no longer be using the CHINA word if I can avoid it, because apparently just saying the word is grounds for a wrongful community violation on TikTok, which I had to appeal. But I digress. The president recently announced a set of new tariffs to place economic pressure on the world's largest exporter. The tariffs would externally hike the cost of goods like solar cells, semiconductors, and medical products. But what matters to Tesla is the increased tariffs on EVs and batteries. The tariffs for EV batteries and components will be raised from 7.5% to 25% across the board, and materials will get hit with new 25% tariffs. As for the EVs themselves, the rate will be raised from 25% to 100%. Let's assume these tariffs hold weight for a second. Why this is good for Tesla is because it reduces the probability of outside competitors like BYD entering the domestic US market, which is a market Tesla still dominates. Tesla's US market share for EV sales was 55% in 2023, with the Model Y making up 33% of all EVs sold the same year. And in Q1 of 2024, Tesla appears to have maintained a majority against all other automakers combined. What the others like Ford and GM are struggling with is the economics of producing their EVs. Much of their process is costing them big money with very little, if any, profit to show for it. If it wasn't for their extremely profitable core business of selling gas-powered vehicles, they'd be in financial trouble. That is not the case for BYD. They've already proven in the world's largest EV market that they can go toe-to-toe with Tesla on both price and vertical integrations. They have economies of scale. They can keep their costs low, whether that's through heavy government subsidies or not. The competition Tesla is experiencing over there would be the same competition experienced here. With the cost of car prices where they are, the interest rates on auto loans, imagine if there was zero friction to getting those $12,000 BYDs to the US. It would be a blow to Tesla, and it would decimate all of the others. So tossing the politics out of the conversation, I think Tesla can benefit from the new tariffs, at least here in the US. They can focus on the market share they currently have and focus on rolling out their new economic models in hopes of capturing more. Okay, there's obviously more to talk about on the topic of Tesla, like the recent laying off of the supercharger team and a brewing lawsuit against the full self-driving feature, but I'll cover those as a part of a larger dedicated video. The supercharger situation in particular was strange to me, but more on that later. Let's leave it there, y'all. GameStop, what do you think? A momentary lapse of reason, or is something deeper going on? And Tesla, let's see if these tariffs hold weight, and do you think they're enough to protect them from domestic competition? Can't thank y'all enough for the support. If you enjoyed the video, be sure to like it and subscribe for more if you aren't already. For any questions, drop those in the comments or feel free to email me at askalexherrera@gmail.com. As always, thanks for watching. Until next time, take care of yourself and best of luck.